There is a profound and dangerous lie at the heart of modern finance, a lie taught in every business school, repeated by every television pundit, and coded into the software that manages trillions of dollars of our collective wealth. This lie is so pervasive, so deeply embedded in the conventional wisdom of investing, that to question it sounds like heresy. The lie is this: that the up and down dance of a stock's price, its volatility, is the very definition of risk. We are told, with the certainty of religious dogma, that a stock that bounces around is risky, while a stock that trades in a smooth, predictable line is safe. This single idea, more than any other, is responsible for the destruction of more wealth, the shattering of more dreams of financial freedom, and the perpetuation of more mediocre investment returns than any market crash in history. It is a siren song that lures investors onto the rocks of poor decision-making, forcing them to buy high in times of placid stability and sell low in moments of terrifying, but ultimately meaningless, price swings. But what if this foundational principle were not just wrong, but the exact opposite of the truth? What if the very thing that the entire financial establishment tells you to fear is, in fact, the single greatest opportunity you will ever be given to build lasting wealth? What if market volatility is not the enemy, but your most powerful and loyal ally? This is not a hypothetical question. It is the core philosophy that transformed a young man from Omaha, Nebraska, into the greatest capital allocator the world has ever known. Warren Buffett's entire fortune, the sprawling empire of Berkshire Hathaway, is built upon the rubble of this academic fallacy. He understood a secret that is hiding in plain sight: that the real risk in investing has absolutely nothing to do with the squiggly lines on a screen. The real risk, the only risk that truly matters, is the permanent loss of your capital. It is the risk of paying $100 for something that is truly only worth $50 and watching that value evaporate forever. It is the risk of entrusting your hard-earned money to a failing business or a dishonest management team. Volatility, on the other hand, is simply the emotional, often irrational, reaction of the crowd to short-term news. It is the noise, not the signal. And for the investor who can separate the two, who can remain calm when others are panicking, that noise creates a symphony of opportunity. This is the great intellectual leap you must make to move from an amateur speculator to a professional investor. You must learn to reject the definition of risk that has been handed to you and replace it with a more powerful, more rational, and infinitely more profitable one. You must rewire your brain to see a stock market crash not as a catastrophe but as a sale. You must learn to see market volatility as a good thing. To truly grasp the magnitude of this mental shift, we must first travel back in time, to the hallowed halls of academia, where this flawed idea of risk was born, and where Buffett first threw down the gauntlet against it. In 1984, Columbia Business School was celebrating the 50th anniversary of the publication of the foundational text of value investing, Security Analysis, by Benjamin Graham and David Dodd. The intellectual climate of the era was dominated by a theory known as the efficient market hypothesis. This theory, championed by the brightest minds in finance departments from Chicago to Cambridge, argued that all known information about a company is instantly priced into its stock. Therefore, it was impossible to consistently beat the market. Any outperformance, the theory went, was the result of either taking on more risk, which they defined as more volatility, or pure, dumb luck. The professors had created complex mathematical models to prove this, with Greek letters like beta representing a stock's volatility relative to the market. A high beta stock was risky, a low beta stock was safe. It was elegant, it was mathematical, and it was taught as gospel. Into this environment stepped Warren Buffett, a former student of Benjamin Graham himself, to deliver a speech that would become legendary: the super investors of Graham and Doddsville. He stood before this assembly of academic elites, not with complex equations, but with a simple, undeniable collection of facts. He presented the track records of 9 different investors, all of whom were disciples of the Graham and Dodd school of thought. These were not household names at the time. Investors like Walter Schloss, Tom Knapp, and Buffett's own partner, Charlie Munger. Over decades, each one of them, operating independently, with different stocks and at different times, had absolutely crushed the market averages. They had generated returns that the efficient market hypothesis claimed were statistically impossible. Buffett laid out the numbers year by year, letting the brutal, unrelenting facts speak for themselves. He then posed a simple question. If you were to hold a national coin-flipping contest, with 225 million Americans each flipping a coin once a day, by the end of 20 days, you would statistically have 215 people who had flipped heads 20 times in a row. The academics, he said, would look at this group and dismiss it as luck. But what if, he continued, you discovered that all 215 of those winners came from the same small town in Nebraska? You would immediately suspect that something else was at play. There had to be a common cause, a shared methodology. This, he argued, was exactly the case with the super investors. They all came from the same intellectual village, Graham and Doddsville. They all shared a common philosophy, that you look at stocks as businesses, you determine their intrinsic value, and you buy them for far less than they are worth, a concept known as the margin of safety. Their success had nothing to do with the volatility of their stocks, their beta, or their position on a risk-return graph. Their success was due to one thing: consistently buying dollar bills for 50 cents. Buffett was directly challenging the core of their belief system. He was arguing that risk wasn't about the pattern of a stock's price. Risk was about the price you paid relative to the value you received. A volatile stock bought at a ridiculously cheap price was far less risky than a stable stock bought at an exorbitant one. The academics were polite, but largely dismissive. The speech, however, became a seminal text for a generation of value investors, a declaration of independence from a flawed and dangerous ideology that continues to dominate mainstream portfolio management to this day. The reason this academic definition of risk remains so powerful, despite mountains of evidence against it, lies deep within our own psychology. We are susceptible to what is known as the authority bias. When a concept is presented by figures of authority, tenured professors at prestigious universities, Nobel laureates, highly paid financial advisors, and wrapped in the complex language of mathematics and Greek letters, our natural inclination is to accept it without question. We assume that if it's that complicated, it must be true, and that these experts must know more than we do. This is a cognitive shortcut our brains use to navigate a complex world, but in the realm of investing, it can be catastrophic. The concept of beta, the measure of volatility, feels scientific and precise. It gives us a single number to latch onto, a seemingly objective measure of risk. It's far easier to look up a stock's beta than it is to do the hard, qualitative work of reading 10 years of annual reports, analyzing a company's competitive position, and judging the quality of its management. The authority of academia provides an easy answer, and we gratefully accept it, outsourcing our critical thinking. But this bias doesn't work alone. It's amplified by what Charlie Munger calls the Lollapalooza effect, where multiple psychological tendencies combine to create a powerful, irrational outcome. The authority bias combines with our desire for simplicity, our fear of uncertainty, and our tendency to follow the herd. When everyone around you, from your advisor to the financial news, is talking about risk in terms of volatility, it becomes incredibly difficult to hold a contrarian view. This creates a self-reinforcing loop. The more people believe volatility is risk, the more they sell volatile stocks during downturns, which makes them even more volatile, which proves to them that the stocks were risky in the first place. It is a mass delusion, propped up by academic authority and fueled by our own cognitive flaws. Buffett's genius was not just in seeing the logical fallacy of the theory, but in recognizing and insulating himself from the psychological forces that give it power. So how can you, the individual investor, break free from this powerful deception? You must create your own mental model, a practical blueprint for redefining risk on your own terms. It begins with an exercise I call the risk redefinition audit. Take out a piece of paper or open a spreadsheet and list the top 5 largest holdings in your investment portfolio. Next to each company's name, I want you to look up its beta. You can find this on any major financial website. Write that number down. Now I want you to take a thick, black pen and draw a line right through it, crossing it out completely. This is a symbolic act of liberation. You are officially rejecting the academic definition of risk. Now in the space next to it, you are going to replace that single, misleading number with the answers to 3 far more important questions. Question 1. The durability test. Could this business be seriously, fundamentally damaged or even wiped out by a competitor or a technological shift in the next 10 years? Be brutally honest. Is this a business with a deep, protective moat around it, like a powerful brand or a low-cost production advantage? Or is it a company in a cutthroat industry, fighting for survival every day? Answer yes or no, and then write 1 sentence explaining why. Question 2. The jockey test. Is the management team running this company both honest and competent? Have you read their letters to shareholders? Do they talk candidly about their mistakes, or do they constantly blame external factors? Are they allocating capital intelligently, by buying back shares when they're cheap or making smart acquisitions? Or are they engaging in empire building at the expense of shareholder value? Find concrete evidence to support your assessment. Question 3. The price test. Did I purchase my shares in this business at a price that provided a significant margin of safety? This requires you to have some estimate, however rough, of the company's intrinsic value, what a rational private owner would pay for the whole enterprise. Is the price you paid at least 30 to 50% below that value? Show your basic math. Don't worry if it's not perfect. The act of thinking through it is what matters. Once you have completed this audit for your top holdings, you will have performed a profound mental shift. You will no longer see risk as a jittery stock price. You will see risk for what it is: the possibility of a permanent erosion of a company's earning power, the danger of entrusting capital to bad managers, and the folly of overpaying for an asset. This is the foundation of sound long-term wealth management. The path of the 99%, the antithesis of this approach, is a direct consequence of accepting the academic lie. They fall into what can only be described as the diversification trap. Terrified by volatility, they are advised to diversify their holdings as much as possible. This seems prudent on the surface. Don't put all your eggs in one basket. The problem is how this advice is implemented. Investors end up buying mutual funds or exchange-traded funds, ETFs, that hold hundreds, sometimes thousands of different stocks. They believe this diversification makes them safe. In reality, it does 2 terrible things. First, it guarantees mediocrity. By owning a slice of everything, you are mathematically guaranteed to achieve the market's average return, minus the fees you pay for the privilege. You have diversified away any chance of exceptional performance. But the second, more insidious effect is that it creates a false sense of security. The investor who owns a broad market ETF has no real understanding of the underlying businesses they own. They own a ticker symbol, a collection of hundreds of companies, good, bad, and ugly. They have outsourced their thinking completely. So when a real stock market crash occurs, when the entire market is plunging 30 or 40%, they don't have the conviction that comes from deep knowledge. They haven't done the risk redefinition audit. They don't know which of their hundreds of holdings are truly durable businesses and which are on the brink of failure. All they see is the value of their portfolio plummeting, their life savings evaporating. Their only reference point is the price, and the price is screaming danger. Panic sets in, and they sell at the absolute bottom, locking in a permanent loss of capital, the very thing they were trying to avoid. They mistook diversification for safety, when in fact, true safety comes from concentrating your capital in a small number of wonderful businesses that you understand deeply and bought at a sensible price. The direct financial connection between rejecting the academic definition of risk and building real wealth is stark and undeniable. Let's imagine 2 investors. Investor A follows the conventional wisdom. He is looking for low-risk investments and is told to look for stocks with a low beta. He finds a utility company, let's call it Stablecorp. It has a beta of 0.7, meaning it's 30% less volatile than the overall market. The stock price barely moves. However, it's a darling of the safety crowd, and its stock has been bid up to a price of 50 times its annual earnings. Investor B has done the work. She understands that real risk is about business fundamentals and price paid. She finds a fantastic technology company, Dynamic Inc. It's the dominant player in its field with a huge moat, but it operates in a sector prone to mood swings. A recent bout of negative headlines has caused a market panic, and the stock has fallen 40%. Its beta is a terrifying 1.6, meaning it's 60% more volatile than the market. But at this depressed price, it's trading for only 10 times its earnings. The academic world would scream that Stablecorp is the safe investment and Dynamic Inc. is the risky one. But what happens next? Stablecorp is already priced for perfection. Any small hiccup in its business, a regulatory change, an increase in interest rates, could cause its absurd valuation to collapse, leading to a permanent 50 or 60% loss of capital from which it may never recover. The risk of permanent loss is incredibly high. Dynamic Inc., on the other hand, is priced for disaster. All the bad news is already baked in. Because it's a superior business, it continues to grow its earnings. As the market panic subsides, the valuation multiple expands from 10 back to a more reasonable 20. The combination of earnings growth and multiple expansion could lead to the stock tripling in value over the next few years. The temporary volatility provided the entry point. The business quality provided the long-term return. By embracing market volatility, Investor B was able to make an investment with a massive margin of safety, dramatically lowering her real risk, while setting herself up for the kind of returns that lead to true financial freedom. This is how a simple shift in mindset directly translates into a massive financial advantage. It is the first and most critical step in learning how to invest. Once you have liberated your mind from the dogma that volatility equals risk, you are ready to embrace the second great pillar of Buffett's philosophy, the personification of the market itself. To merely understand intellectually that market swings are opportunities is not enough. Our brains are not wired for pure logic. They are emotional machines. During a market crash, fear is a primal, overwhelming force. To conquer it, we need a more powerful mental framework, a story that allows us to reframe what is happening. This framework was gifted to Buffett by his mentor, Benjamin Graham, in the form of a simple but profound parable, the story of Mr. Market. Graham asks you to imagine that you are a private owner of a business, and you have a partner named Mr. Market. Every single day, without fail, Mr. Market shows up at your door and offers to either buy your share of the business or sell you his, at a specific price. The most important thing to know about Mr. Market is that he is a manic depressive. Some days, he is euphoric. He sees nothing but a glorious future for your business and offers you a ridiculously high price for your shares. On other days, he is consumed by despair. He is convinced the business is doomed, that the world is ending, and he offers to sell you his shares for pennies on the dollar. He has another crucial characteristic. He doesn't mind being ignored. If you don't like his price today, he'll be back tomorrow with a new one. The choice to transact is always yours. He is your servant, not your master. This simple story is one of the most powerful tools ever devised for successful portfolio management, because it transforms you from a passive victim of market fluctuations into an active opportunist. The daily quotes you see on a screen are not a judgment on your intelligence or the quality of your business. They are simply offers from your emotionally unstable partner. Your job is not to be influenced by his mood, but to exploit it. When he is euphoric, you can happily sell him your shares if the price is absurd. When he is terrified, you should be backing up the truck and buying everything he is willing to sell you on the cheap. This mental model is the psychological shield that allows you to remain rational when everyone else is losing their minds. The power of the Mr. Market analogy is perfectly illustrated by one of Buffett's earliest and most spectacular investments, the American Express salad oil scandal of 1963. At the time, American Express was a rock-solid blue-chip company, known primarily for its traveler's checks and charge card, a sort of proto-credit card. It was a business built on the bedrock of trust, but it had a small, obscure division that issued warehouse receipts, essentially guaranteeing that collateral stored in a warehouse actually existed. One of their biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Anthony Tino DeAngelis. Tino was a charismatic fraud. He had managed to borrow hundreds of millions of dollars against his company's massive inventory of salad oil. The problem was, the inventory didn't exist. The giant tanks were mostly filled with water, with a few feet of oil floating on top. When the fraud was discovered, Allied Crude collapsed, and Wall Street panicked. The headlines were brutal. The fear was that American Express, which had guaranteed the warehouse receipts, would be on the hook for the massive losses, potentially bankrupting the entire company. Mr. Market was not just depressed, he was suicidal. The stock of American Express was crushed, falling nearly 50% in a matter of weeks. This was extreme market volatility. The financial establishment, gripped by fear, dumped the stock. But Warren Buffett, viewing the situation through the lens of the Mr. Market parable, saw not a crisis but an offer. He didn't focus on the screaming headlines or the plunging stock price. He went out and did the work of a business analyst. He visited restaurants and banks. He talked to merchants. He asked them a simple question: are you going to stop accepting American Express cards or traveler's checks because of this scandal? The answer was a resounding no. He even went to American Express's direct competitors and asked if they were seeing a surge in new customers fleeing Amex. They weren't. Buffett quickly realized that the scandal, while serious for the small warehousing division, had done absolutely nothing to damage the company's core businesses. The powerful brand, the consumer trust, the fundamental earning power of the charge card and traveler's check franchises were completely intact. He concluded that the intrinsic value of the business was at least $60 per share, while a terrified Mr. Market was offering to sell it to him for just $35. Buffett acted decisively. He invested 40% of his entire investment partnership's capital into American Express stock. It was the single largest investment he had ever made. Over the next few years, as the company sorted out the salad oil mess and its powerful core businesses continued to thrive, the market's mood swung from despair back to euphoria. The stock price soared, and Buffett's partners reaped an enormous profit. He hadn't predicted the market. He had simply recognized a wonderful business being offered at a foolish price by his manic-depressive partner, and he had the courage to act on it. This story reveals the specific cognitive biases that Mr. Market exploits in the average investor, and which Buffett so skillfully overrides. The primary culprit is the availability heuristic. Our brains tend to judge the likelihood of an event based on how easily we can recall examples of it. When a dramatic, negative event like the salad oil scandal dominates the news, it becomes highly available in our minds. The vivid imagery of fraud, bankruptcy, and financial ruin fills our thoughts. This leads to a second bias, the affect heuristic, where our emotional response to the news, in this case, fear and disgust, colors our rational judgment of the situation. We don't dispassionately analyze the balance sheet. We feel the fear of the headline and assume the entire company is tainted. The negative emotion bleeds over from the specific problem, the warehousing division, to the whole enterprise, American Express. We make a fast, intuitive, and deeply flawed judgment. This is what happened to the sellers of Amex stock in 1963. They were reacting to the available, frightening narrative. Buffett, by contrast, deliberately insulated himself from this emotional contagion. He didn't read the headlines. He went out and collected his own, less emotionally charged data from the real world. He forced himself to use his slow, analytical brain instead of his fast, intuitive one. The Mr. Market mental model is a tool for creating this psychological distance. By personifying the market's irrationality, it allows you to step back and observe the mass hysteria from a detached perspective, rather than getting swept up in it. It reminds you that the source of the price quotes is an unreliable, emotional entity, allowing you to engage your logical mind and ask the right questions, just as Buffett did. To operationalize this in your own life, you must adopt what I call the Mr. Market daily practice. It's a simple mental exercise that over time will fundamentally change your relationship with the stock market. Every morning, when you first look at the market or check your portfolio, do not see numbers on a screen. Instead, consciously visualize Mr. Market knocking on your front door. Picture him. Some days he's wearing a party hat, jumping up and down with excitement, yelling about how the sky's the limit, and offering to buy your shares of your favorite company for double what you paid. On other days, he's dressed in rags, weeping, convinced of impending doom and begging you to take his shares off his hands for a fraction of what they're worth. The first and most important rule of this practice is this: you are under no obligation to open the door. You can simply ignore him. His daily visit is an offer, not a command. Most days, his prices will be neither ridiculously high nor absurdly low. On those days, you simply go about your business. The second step is to ask yourself a single question. Is my partner's mood today offering me a clear and compelling opportunity? Notice the wording. The focus is not on what the market is doing to you, but on what it is offering you. This simple reframing shifts your posture from defensive to offensive, from reactive to proactive. If he is euphoric and offering a price far above your estimate of intrinsic value, perhaps you should consider selling. If he is in the depths of despair, offering a price far below intrinsic value for a business you've already researched and want to own, then you must act. By consistently applying this mental model, you will sever the emotional cord that connects your mood to the markets. Price fluctuations will cease to be a source of anxiety and will instead become a potential source of profit. You will achieve the investor's state of grace, equanimity in the face of chaos. This is the cornerstone of effective contrarian investing. The antithesis of this disciplined mindset is the path followed by the vast majority of market participants, the screen watcher's folly. The average investor does not see Mr. Market as a manic depressive servant. They see him as an all-knowing oracle. The ticker tape is not an offer, it is a report card on their intelligence. They glue themselves to their screens, watching the endless stream of green and red numbers. Every tick-up is a small dose of dopamine, a confirmation of their genius. Every tick-down is a pang of anxiety, a signal of their failure. They have become a puppet, and Mr. Market is pulling the strings. This behavior leads to a predictable and disastrous cycle. During bull markets, when Mr. Market is euphoric, the constant green on the screen fuels their greed and FOMO, the fear of missing out. They see others getting rich and feel compelled to buy, often piling into the most popular stocks at the highest valuations. They buy at the point of maximum financial risk. Then, when the inevitable stock market crash arrives and Mr. Market is panicking, the sea of red on their screen triggers an overwhelming fear response. Their entire emotional framework is built on price as truth. So when the price is collapsing, the only logical conclusion is that the underlying business must be worthless. They sell in a panic, often near the bottom, to stop the pain. They sell at the point of maximum financial opportunity. This behavior, repeated over and over, is the structural reason why most people underperform the market. They are emotionally hardwired to buy high and sell low. They are Mr. Market's plaything, constantly whipsawed by his moods, their financial future dictated by his irrational whims. The constant activity also racks up transaction costs and taxes, creating a relentless headwind against their returns. They are trapped on an emotional and financial roller coaster of their own making, all because they have the relationship with the market exactly backward. The direct financial connection of mastering the Mr. Market analogy is the transformation of market drawdowns from terrifying losses into wealth-generating deposits. Let's quantify this. Imagine a great business whose stock is trading at $100 per share. You've done your homework and believe its intrinsic value is around $120. A market panic hits, unrelated to the company's long-term prospects. Mr. Market, in his despair, offers to sell you shares at $50. The typical investor, the screen watcher, who owned the stock at $100, now looks at their portfolio and sees a catastrophic 50% loss. Their fear response is screaming, and they are tempted to sell to prevent further damage. The investor who understands Mr. Market sees something entirely different. They see the future earnings and dividends of this great business, now available at half price. They see the opportunity to purchase a dollar bill of value for 42 cents, $50 price, $120 value. Let's say they invest $10,000. At $100 per share, they could buy 100 shares. But by waiting for Mr. Market's panic, they can buy 200 shares with the same $10,000. When the market eventually recovers and the stock returns to its intrinsic value of $120, the first investor who bought at $100 has a 20% gain. The second investor who bought at $50 has a 140% gain. The second investor's long-term compound annual growth rate is radically higher. They didn't need to find a different company, they simply chose a different time to buy the same company, a time dictated by emotion rather than reason. By systematically using market volatility as their purchasing agent, they are able to acquire more shares of great businesses for the same amount of capital. Over an investing lifetime, this single skill, the ability to be greedy when others are fearful, is the most powerful accelerator of wealth you can possibly possess. It is the key to buying the dip not as a panicked gamble, but as a disciplined strategy for achieving financial freedom. If volatility is not risk and market fluctuations are an opportunity to be exploited, then what is the true nature of risk? What is the enemy that the serious investor must guard against at all times? This brings us to the third and perhaps most crucial pillar of Buffett's philosophy, the anatomy of real risk, viewed not from the perspective of a stock trader, but from the perspective of a business owner. For Buffett, the ultimate risk is not that a stock price will go down, it is that the underlying business you own will earn less money in the future than you expect it to when you buy it. This is what leads to the permanent loss of capital. This risk can be broken down into three primary components. First, there is business risk, the danger that a company's competitive position will erode over time. Second, there is management risk, the chance that the executives running the company will make poor decisions, destroying value through incompetence or dishonesty. And third, there is valuation risk, the folly of paying too high a price for even a wonderful business, leaving no room for error and no margin of safety. Notice what is absent from this list: stock price volatility. To Buffett, that is an external factor, a noise created by Mr. Market. The real risks are internal to the business itself and the price you pay for it. This shift in focus is everything. It moves your analysis away from the stock chart and onto the financial statements, away from the daily news cycle and onto the company's long-term competitive strategy. The moment this distinction crystallized for Buffett can be traced to a single transaction in 1972, the acquisition of See's Candies. At this stage in his career, Buffett was still very much a pure disciple of Ben Graham's cigar butt investing. He looked for statistically cheap companies, often mediocre businesses trading for less than their net working capital. He was buying bargains, not great companies. See's Candies was different. It was a beloved, family-owned chocolate company on the West Coast with a fanatically loyal customer base. It was, by any measure, a wonderful business. It had a powerful brand, which allowed it to consistently raise its prices without losing customers, a phenomenon Buffett would later call pricing power. The problem was, it wasn't statistically cheap. The sellers were asking for $25 million, which was about 3 times the company's book value. To the younger cigar butt era Buffett, this was anathema. You just didn't pay that kind of premium. But his partner, Charlie Munger, pushed him relentlessly. Munger argued that they were not just buying tangible assets like factories and inventory. They were buying an intangible asset of immense value, the See's brand name in the mind of its customers. This brand was a deep competitive moat that protected the business from competition. Munger convinced Buffett that the real risk was not in paying a seemingly high price for a superior business, but in passing up the opportunity to own such a high-quality asset that would compound its value for decades to come. They bought the company, The decision would permanently alter Buffett's DNA as an investor. Seas went on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway on an initial investment of just $25 million, and it required very little additional capital to do so. It was a cash-generating machine. The lesson was profound. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. He learned that the highest risk often comes disguised as statistical cheapness in a bad business, while true safety is found in the durable earning power of a great one, even if you have to pay a reasonable price for it. This was the moment he fully transitioned from being a stock picker to a business owner who happened to transact in the stock market. The psychological bias that almost caused Buffett to miss the See's Candies deal is known as the focusing illusion. This is our tendency to give too much weight to a single, easily quantifiable piece of information when making a decision, while ignoring other, more important but less tangible factors. For the early Buffett, the focusing illusion was the price-to-book ratio. It was a simple, concrete number that had served him well. He was so focused on this one metric of cheapness that he was blind to the far more significant value embedded in See's brand and customer loyalty. Investors fall prey to the focusing illusion all the time. They might become obsessed with a company's dividend yield, ignoring the fact that the company is taking on huge debt to pay it. They might focus on a low price-to-earnings ratio without realizing the company is in a dying industry. Or they might get fixated on rapid revenue growth, overlooking the fact that the company is burning through cash and has no path to profitability. The illusion makes us substitute an easy question: is this P/E ratio low, for a hard one? Is this a durable business with honest management that I can buy at a sensible price? The See's Candies experience taught Buffett and Munger to combat this bias by taking a more holistic view of value. They learned that the most important qualities of a business, its competitive moat, the integrity of its management, its ability to withstand change, are often not found in a single line item on the financial statements. They require qualitative judgment, the kind of thinking a business owner does, not a security analyst just crunching numbers. To build this business owner's perspective and avoid the focusing illusion, you need a systematic checklist to analyze the real risks of an investment. Buffett and Munger have refined their approach over the years into what can be thought of as the 4 filters risk checklist. Before you ever consider buying a stock, you must be able to answer a firm yes to each of these 4 questions. Filter 1. The business filter. Do I understand this business? This is Buffett's famous circle of competence. If you can't explain in simple terms how the company makes money, what its competitive advantages are, and what the major threats to its future are, you have no business owning it. The filter also demands a consistent operating history and favorable long-term prospects. You're not looking for speculative turnarounds. You're looking for established, durable enterprises. Filter 2, the management filter. Is the management team rational, candid, and shareholder-oriented? Read their annual letters to shareholders. Do they admit their mistakes? Is their compensation tied to long-term performance? Most importantly, do they resist the institutional imperative, the tendency for corporate leaders to mindlessly imitate their peers, whether it's by making foolish acquisitions or diversifying into areas they don't understand? You are looking for managers who think and act like owners. Filter 3, the financial filter. Does the business have strong underlying economics? This means looking for companies with consistently high returns on equity without using a lot of debt. You should focus on what Buffett calls owner earnings, a more realistic measure of free cash flow rather than just reported net income. A healthy business gushes cash, a risky one consumes it. Filter 4, the value filter. Can I buy this business at a significant discount to its intrinsic value? This is the margin of safety concept. No matter how wonderful the business, the price you pay determines your return. You must buy it at a price that provides a cushion in case your analysis is wrong or the future is not as bright as you expect. This 4-filter checklist is a powerful antidote to the focusing illusion. It forces you to look at the entire picture, the business, the people, the finances, and the price, and prevents you from being seduced by a single, misleading data point. It is a blueprint for making decisions based on business reality, not market sentiment. The antithesis to this disciplined, business-focused approach is the path of the story stock chaser. This is the investor who falls in love with a narrative. They aren't buying a business, they are buying a dream. The story might be about a revolutionary new technology, a disruptive business model, or a visionary CEO who is going to change the world. These stories are exciting, and they spread like wildfire, especially during bull markets. The story stock chaser completely ignores the four filters. The business filter? The business is often incomprehensible, based on unproven technology or a future that may never arrive. They don't have a consistent operating history. They have a vision. The management filter? Management is often promotional, making grand promises while their track record is thin or non-existent. The financial filter? The financials are often a disaster, a sea of red ink, massive cash burn, and a constant need to raise more capital by issuing new stock. The value filter? Valuation is completely detached from reality. Since there are no earnings, the company is valued on metrics like price to sales, or, even worse, price to eyeballs. The valuation is based on hope, not on assets or earning power. The dot-com bubble of the late 1990s was the ultimate example of this folly. Investors poured billions into companies with exciting stories but no viable business models. They ignored the four filters completely. When the narrative broke and the cash ran out, the stocks collapsed, many of them going to zero. The investors suffered a 100% permanent loss of capital. They learned the hard way that a compelling story is no substitute for a sound business. The risk was not that these stocks were volatile, they were incredibly volatile. The risk was that there was no underlying value to begin with. The direct financial connection between focusing on business quality and long-term wealth is found in a company's ability to compound its intrinsic value over time. Let's compare two hypothetical companies, each with a stock price of $100. Company A, Struggle Co., is in a fiercely competitive, capital-intensive industry, like an airline or a steel mill. To simply stay in business, it must constantly spend huge sums on new planes or modernizing its factories. Its profit margins are razor-thin, and it carries a lot of debt. Even though it might generate $1 billion in revenue, after all the costs and capital expenditures, it might only produce $20 million in true owner earnings. Its return on invested capital is pitifully low. Company B, Quality Co., is modeled after See's Candies. It has a powerful brand and a loyal customer base. It operates in a stable industry and requires very little new capital investment to grow. It can raise its prices every year, and its profit margins are wide. From its $1 billion in revenue, it might generate $200 million in owner earnings. Its return on invested capital is exceptionally high. Now let's look at their balance sheets. Struggle Co.'s balance sheet is weak, burdened by debt and heavy assets. It is fragile. Quality Co.'s balance sheet gets stronger every year as the pile of cash it generates grows. It is robust. An investor who buys Struggle Co. even at a seemingly cheap price is taking on immense business risk. The company has no moat, and a recession or a price war could wipe it out. The investor who buys Quality Co., even at a fair price, is buying a financial fortress. The company's moat, its brand, manifests directly as superior free cash flow and a bulletproof balance sheet. Over a decade, Quality Co. will be worth many times what it is today, as it consistently gushes cash that can be reinvested or returned to shareholders. Struggle Co. will be lucky to survive. The ability to distinguish between these two types of businesses is the core skill of capital preservation and long-term wealth creation. It is the heart of what separates true investing from mere speculation. Once you have redefined risk and learned to focus on business quality, you must master the fourth pillar, the operational discipline of when to act. It's not enough to have the right philosophy, you must have the right temperament. This is the fat pitch doctrine, a philosophy of extreme patience combined with extreme decisiveness. Buffett famously uses a baseball analogy to explain this concept. An investor in the stock market has a huge advantage over a baseball player. In baseball, if a player lets 3 good pitches, 3 strikes, go by without swinging, they are out. In investing, There are no called strikes. You can stand at the plate all day watching thousands of pitches, investment opportunities, go by. You can watch high-flying tech stocks, volatile biotech companies, and stodgy industrial firms float past. You don't have to swing at any of them. Your goal is not to swing often, but to wait patiently for the perfect pitch, the one that is right in your sweet spot, the fat pitch that you know you can hit out of the park. For Buffett, a fat pitch is a business that passes his 4 filters with flying colors, run by management he trusts, and which, due to some temporary market panic or neglect, is being offered at a ridiculously cheap price. These opportunities are rare. You might only get a few of them in a decade. But the key to extraordinary returns is to do nothing, absolutely nothing, until one of these opportunities appears, and then, when it does, to swing with immense force, to invest a significant portion of your capital. It is a strategy of calculated inaction followed by concentrated action. The ultimate demonstration of this doctrine in practice was Warren Buffett's conduct during the 2008 financial crisis. For several years leading up to the crisis, during the housing bubble, Buffett had been largely inactive. Berkshire Hathaway's cash pile had swelled to tens of billions of dollars. He saw speculation everywhere. Prices were high, and Mr. Market was euphoric. He couldn't find any fat pitches, so he refused to swing. He was criticized for losing his touch and for the cash drag on Berkshire's performance. He patiently stood at the plate, waiting. Then, in the fall of 2008, the world fell apart. Lehman Brothers went bankrupt. The credit markets froze. The global financial system was on the brink of collapse. Market volatility was at levels never seen before. Fear was absolute. For Buffett, this was not a crisis. It was the fat pitch he had been waiting for his entire life. The phone at his Omaha office started ringing. On September 23, Goldman Sachs, one of the most prestigious investment banks in the world, was on the line, desperate for capital to shore up its balance sheet and restore confidence. In a matter of hours, Buffett struck a deal to invest $5 billion in Goldman. It was not a simple stock purchase. He bought preferred stock paying a 10% dividend, and he received warrants to buy common stock at a fixed price in the future. The terms were extraordinarily favorable to Berkshire. A few weeks later, he made a similar $3 billion investment in General Electric. In October, with the market in freefall, he penned an op-ed for the New York Times titled, "Buy American, I Am." He laid out his simple thesis: the country's long-term prosperity was intact, and the fear gripping the market was providing a once-in-a-generation opportunity to buy wonderful businesses on sale. He then went on to invest billions more, including a landmark deal with Bank of America in 2011. He didn't just swing, he swung for the fences. His actions were a masterclass in the fat pitch doctrine. Years of patience, hoarding cash while others were greedy, followed by breathtakingly swift and decisive action when others were terrified. The psychological forces that Buffett had to overcome to execute this strategy are immense. The first is action bias. Our brains are wired with a preference for action over inaction, even when inaction is the more rational choice. In investing, this is a deadly impulse. When markets are calm and going up, investors feel like they should be doing something: trading, tinkering, chasing the latest hot stock. The feeling of being idle is uncomfortable. This leads to overtrading and buying into mediocre ideas just for the sake of being active. The second and more powerful force is the fear of missing out, or FOMO. This is particularly potent during bull markets. Watching your friends and neighbors get rich on stocks you don't own creates a powerful social pressure to jump in, often at the peak of the market. It's a form of herd behavior, driven by the primitive fear of being left behind by the tribe. Buffett's ability to sit patiently on mountains of cash while the dot-com bubble and the housing bubble raged was a testament to his immunity to FOMO. The fat pitch doctrine is a direct antidote to these biases. It gives you a reason, a justification for inaction. You are not being lazy, you are being disciplined. You are not missing out. You are preserving your capital and your focus for the truly exceptional opportunities. It provides a framework that makes patience a strategic virtue, not a sign of weakness. To instill this discipline in yourself, you must adopt another one of Buffett's powerful mental models, the 20-slot punch card analogy. He asks you to imagine that when you are born, you are given a punch card with only 20 slots on it. Each time you make an investment, you have to punch one of those slots. That's it. You only get 20 investment decisions for your entire life. Now think about how that would change your behavior. You would become incredibly selective. You wouldn't waste a precious punch on a speculative idea you heard about on TV. You would do deep, thorough research. You would wait for an opportunity that was so compelling, so close to a sure thing, that you would be happy to allocate a significant portion of your net worth to it and have it occupy one of your 20 slots. This mental model accomplishes two things. First, it kills the urge for constant activity. It forces you to treat every investment decision with the gravity it deserves. Second, it encourages you to be decisive when you finally find an opportunity that meets your strict criteria. Because you know how rare a true 20-punch idea is. When you find one, you will have the conviction to invest heavily, rather than just taking a small, timid position. Start applying this model today. Before you buy any new stock, ask yourself the question, is this business so good, and is the price so attractive, that I am willing to punch one of my 20 lifetime slots for it? If the answer is anything less than an enthusiastic yes, then the correct course of action is to do nothing. The path of the 99% is the exact opposite of this patient, selective approach. It is the path of the hyperactive trader. The hyperactive trader believes that activity equals results. They are constantly monitoring the market, reading financial news, and listening to expert predictions. They have a portfolio of dozens of stocks, and they are always buying and selling, trimming a position here, adding to one there. They are convinced they can outsmart the market through sheer effort and speed. This strategy is doomed to fail for several reasons. First, it is a killer on costs. Every trade incurs transaction fees, and every short-term gain is taxed at a higher rate. These costs create a constant drag on returns that is nearly impossible to overcome. Second, it's psychologically exhausting. The constant decision-making, the emotional highs of a good trade, and the lows of a bad one lead to burnout and poor judgment. Third, and most importantly, it makes it impossible to think like a business owner. By trading in and out of stocks, you are treating them as pieces of paper, not as ownership stakes in real enterprises. You never have the time or the incentive to do the deep research required to truly understand a business. The hyperactive trader is perpetually stuck at the surface, reacting to news and price movements. They are guaranteed to miss the great long-term compounders because they lack the patience to own them through their inevitable periods of market volatility. Their frenetic activity ensures they will never be ready, financially or mentally, for the rare fat pitch when it finally arrives. They've already used up all their punches on mediocre ideas. The direct financial connection of the fat pitch doctrine lies in the power of concentrated, asymmetric bets. Let's compare two portfolios, each starting with $100,000. Portfolio A belongs to a hyperactive, diversified investor. It holds 100 different stocks, essentially mirroring the market. Over 10 years, the market does reasonably well, returning an average of 8% per year. After accounting for fees and taxes from overtrading, let's say the net return is 6%. After a decade, the portfolio is worth about $179,000. Portfolio B belongs to an investor following the fat pitch doctrine. For the first 4 years, the market is overvalued, and she does nothing. Her $100,000 in cash earns almost nothing. Then, a market crash occurs, similar to 2008. She identifies two fat pitch opportunities, two wonderful businesses that she understands deeply, whose stocks have fallen by 50%. She invests $50,000 into each. Over the next 6 years, the market recovers. these two great businesses not only recover, but go on to thrive. Their stocks triple from their depressed lows. Her initial $100,000 is now worth $300,000. The power of waiting for that one moment of extreme market volatility and acting with conviction completely overwhelms the returns from a decade of diversified, continuous activity. One or two great decisions, made possible by patience and courage, can generate more wealth than 1,000 mediocre ones. This is how you truly beat the market. It is not about being smarter every day. It is about being wiser at the moments that matter most. It is a cornerstone of professional portfolio management and is equally applicable to entrepreneurs deciding where to allocate their business's precious capital. This brings us to the final pillar, the grand synthesis of the entire philosophy: structuring your financial life to not just survive volatility, but to feed on it. The goal is to build an anti-fragile portfolio, a system that actually becomes stronger, more powerful, and more profitable as a result of market chaos and shocks. This is the ultimate expression of turning market volatility from a threat into an advantage. The perfect model for this is not a stock portfolio, but the structure of Berkshire Hathaway itself. Berkshire is not a mutual fund. It is a financial fortress, meticulously designed over decades to thrive in precisely the kind of environment that destroys others. Its structure has two main components. The first is a collection of wholly owned, cash-gushing operating businesses. These are companies like the BNSF Railroad, Berkshire Hathaway Energy, and a massive portfolio of insurance companies. These are the bedrock of the fortress. They are not subject to the daily whims of Mr. Market. They chug along, year after year, generating a massive and predictable stream of cash. The insurance businesses are particularly brilliant, as they provide Berkshire with billions of dollars in float premiums that are collected up front and only paid out as claims later. This float is essentially a long-term, interest-free loan that Buffett can invest for Berkshire's benefit. This is the stable, cash-generating core. The second component is a portfolio of concentrated stock positions in other wonderful companies, like Apple and Coca-Cola. This is the opportunistic arm of the company. The magic is in how these two pieces work together. When a stock market crash like 2008 happens, the operating businesses don't stop generating cash. The railroad keeps running, people keep paying their electricity bills, and the insurance float keeps coming in. This constant torrent of cash provides the ammunition. As the stock market plunges, Buffett is able to take the fresh cash being generated by his fortress and deploy it into the public markets at bargain prices, as he did with Goldman Sachs and Bank of America. The crisis for everyone else becomes the opportunity for Berkshire. The structure is designed to be greedy when others are fearful. It is the very definition of anti-fragile. The psychological genius of this structure is that it insulates its decision-maker from the biases that cripple ordinary investors during a crisis. The first bias is myopic loss aversion. This is our tendency to feel the pain of a loss much more acutely than the pleasure of an equivalent gain. When we look at our portfolio and see it down 30%, the emotional pain is intense, even if the loss is just on paper. This pain often drives the disastrous decision to sell at the bottom, just to make it stop. The Berkshire structure dampens this pain. While the stock portfolio may be down, the steady performance of the operating businesses provides immense psychological comfort and stability. It reminds the manager that the underlying value of the enterprise is robust, even if the public market prices are temporarily insane. The second bias is regret aversion. This is our fear of making a decision that might turn out to be wrong in hindsight. This fear can lead to paralysis. An investor might see a fantastic opportunity during a crash but fail to act because they are afraid the stock might go even lower after they buy, making them look foolish. The constant inflow of cash at Berkshire helps overcome this. It creates a forward-looking, offensive mindset. The question is not, what if I'm wrong, but where is the best place to deploy this incoming capital right now? The structure itself fosters the courage required for contrarian investing. It provides the financial and emotional firepower to act decisively when opportunities are greatest. You can apply this same anti-fragile thinking to your own financial life by creating a personal version of the Berkshire structure. using what is known as the barbell strategy. Imagine a barbell with weights on either end and nothing in the middle. This is how you should structure your finances. On one side of the barbell, you place your extremely safe, predictable assets. This is your personal fortress. It includes a robust emergency fund with 6 to 12 months of living expenses, held in cash. It includes your stable career and your earning power. It might include assets like government bonds or real estate that are not highly correlated with the stock market. This side of the barbell is all about survival and capital preservation. It ensures that no matter what happens in the market, your basic needs are met and you will never be a forced seller of your investments. On the other end of the barbell, you place your high-conviction, potentially high-growth investments. This is your concentrated portfolio of a few wonderful businesses that you have researched deeply and which you intend to hold for the long term. This is your offensive wealth creation engine. Crucially, what you avoid is the middle of the barbell. You avoid the mediocre, medium-risk investments, the confusing structured products, the leveraged ETFs, the private equity funds with high fees, the speculative stocks you don't truly understand. These are the investments that offer limited upside but can still blow up and cause a permanent loss of capital. The barbell strategy makes you both extremely defensive and extremely aggressive at the same time. Your safe assets ensure you can survive any storm, and this survival gives you the psychological freedom and the available capital to take meaningful, concentrated risks on the other side, especially during periods of market volatility when those assets go on sale. The antithesis of this robust barbell structure is the fragile, over-optimized portfolio. This is the approach taken by the 99% who are chasing returns without a true understanding of risk. Their portfolios often look brilliant on paper during a long, stable bull market. They might use leverage, borrowed money, to magnify their gains. They might chase stocks with the highest dividend yields, not realizing that these companies are often financially weak and the dividend is unsustainable. They might invest in complex financial products sold to them by advisors. Products they don't remotely understand, but which promise equity-like returns with bond-like risk. These portfolios are optimized for a single, specific scenario, a calm, upward-trending market. They are brittle. They are fragile. The moment a real shock hits the system, a financial crisis, a pandemic, a sudden spike in interest rates, these strategies don't just bend, they shatter. The leverage that magnified gains on the way up now magnifies losses on the way down, leading to margin calls and forced selling at the worst possible moment. The high-yield stocks cut their dividends, and their prices collapse. The complex products reveal their hidden risks and become illiquid. The result is not a temporary drawdown. It is a catastrophic, permanent loss of capital. These investors learn the brutal lesson that a strategy that works 99% of the time can still lead to ruin if it fails completely in the remaining 1%. They built a beautiful house of cards on a foundation of sand, and the first storm washed it all away. The ultimate financial advantage of the anti-fragile barbell approach is in its treatment of cash. For the over-optimized fragile investor, cash is a, quote, drag. They see it as an unproductive asset that earns nothing, and they strive to be fully invested at all times. For the anti-fragile investor, cash is the most powerful strategic asset they possess. In a bull market, cash is boring. But in a bear market, cash transforms. It becomes a high-powered call option on the world's greatest businesses, with no expiration date and no premium. Let's quantify its power. Imagine investor A is fully invested. The market drops 40%. Their portfolio also drops 40%. To get back to even, they need a 67% gain from the bottom. Now consider investor B, who followed a barbell strategy and held 30% of their portfolio in cash. When the market drops 40%, their total portfolio only drops 28%. 70% of the portfolio drops by 40%. Now, at the bottom, they deploy their 30% cash reserve into the beaten-down market. As the market rallies back to its previous high, a 67% gain from the bottom, investor A is merely back to where they started. But investor B's portfolio, supercharged by the cash they deployed at the lows, is now significantly higher than it was before the crash even began. The cash didn't act as a drag, it acted as a slingshot. This is the mathematical payoff for your patience and discipline. By understanding that volatility is not risk, by focusing on business quality, by waiting for the fat pitch, and by structuring your finances to be anti-fragile, you change the entire game. Market crashes cease to be terrifying events to be endured. They become rare and wonderful opportunities to be exploited, the very moments that will lay the foundation for a lifetime of financial success and freedom. You have just invested a significant amount of your most valuable asset, your time, into rewiring the very foundation of how you think about money, risk, and opportunity. The concepts we've explored are not simple tips or tricks. They are a fundamental operating system for rational decision-making in an irrational world. You now possess the mental tool to see what others cannot. That the chaotic dance of market volatility is not a threat to your wealth, but a servant to it. You understand that the financial news is not a report on reality, but a broadcast of Mr. Market's mood swings. You know that the only risk that matters is the permanent loss of capital, and that your greatest defense is to think and act like a business owner, not a speculator. This is a profound and permanent upgrade to your mental arsenal. But it is crucial to understand that this is only one pillar in a much larger architecture of thought. The system that investors like Buffett and Munger use is not a collection of isolated ideas. It is a seamless web of interconnected mental models. The framework for understanding risk that you have just mastered is the foundation, but it is supported by other, equally powerful concepts, models for understanding competitive advantage, for judging management, for calculating intrinsic value, and for mastering your own psychology. Each model strengthens the others. Owning one is like having a single, powerful tool. Owning the entire network of models is like commanding a fully equipped workshop, capable of building anything you desire. The next piece of this map, the next link in this intellectual chain, is right there on your screen. The video that the algorithm has selected for you is not a random suggestion. Think of it as the next step in your journey, the component that connects to what you have just learned and makes it even more powerful. It may be the model that helps you identify the wonderful businesses we spoke of, or the one that teaches you how to master the 20-slot punch card discipline. You have built the foundation. The video on your screen is the blueprint for the first floor. The choice to click is not just about watching another video. It is a decision about who you want to become. Do you want to remain a tourist in the world of serious investing, or are you committed to becoming a master builder? The path to completing your mental arsenal is laid out before you. The next piece of the puzzle is waiting. Continue your ascent, click, and complete the next stage of your transformation.